Okay, so just to briefly recap, okay, in this chapter, we're trying to estimate the required rate of return in order to make a capital budgeting decision. Okay, so we started with, well, in order to, for example, to calculate the weighted average cost of capital, we need to know how to estimate cost of equity, cost of preferred stock, and after-tax cost of debt. Okay, we started with the cost of equity, and we know that in the real world, estimating the cost of equity is very challenging because none of the model is all that powerful and reliable. Well, each one has its own sets of strengths and weaknesses. Okay, so the rule of thumb is that since each one has its own flaws, different flaws, so therefore we're going to use at least 2 and preferably 3 different models to estimate the cost of equity. And we have reviewed how to use CAPM to estimate cost of equity. And now we are talking about how to use one of the dividend models to estimate the required rate of return. And this is where we ended last time here on slide number 11. Okay, so if you find a company that pays dividends regularly, then chances are you may be able to use one of the dividend models to estimate your cost of equity. Okay, so if you find a company that pays not just dividends, but the dividends are growing at a relatively constant rate, then that's an indication we can use constant growth equation to solve for your cost of equity. And with constant growth equation, it says that P0, right, equals to D1 divided by R minus G, right? This is the constant growth equation. So if you find a company that pays regular dividends, while the dividends are growing at a relatively constant rate, you can simply start with this equation, then we'll rearrange this equation to solve for the R in here, right? Assuming this is the assumption that we have to be willing to make. We're assuming that the stock price, whatever the stock price is now, it is traded at the intrinsic value. And thus assume that if the investors are willing to hold on to the stock, then they are implicitly agreeing that this rate of return is acceptable. And therefore, this R is the implied required rate of return. So now mathematically, how do we rearrange this equation to solve for the R? Step 1 is we will exchange your denominator with the P0 on the left. So we now have R minus G on the left equals to D1 divided by P0. Right. Next is we're solving for the R, so we need to get rid of the negative G and move that negative G from the left to the right. To do that, we'll add G to both sides. So R equals to D1 divided by P0 plus G. Okay, so this component is dividend yield. And the second component, this G, is dividend growth rate, is also the capital gains yield. Right, we reviewed that a couple of chapters ago. Now, as far as plugging in the numbers, it's very simple. Okay, let's plug in the numbers together. So suppose that your company is expected to pay a dividend of $1.50 per share next year. So in this demonstration, this is an easier one. Okay, read the question carefully. This is dividend for the next year. So that means this is our D1. Sometimes you may be given D0, other times you may be given D1 directly. So read the question carefully. Okay, and in one of the examples in the future, before the end of this chapter, you will see that you are not always going to be given annual dividend. Okay, you're not always going to be given annual dividend. You could be given quarterly dividend instead. In that case, you need to make sure to convert the quarterly dividend into annual dividend. So read the question carefully. Okay, the math portion should be pretty simple. It has been a steady growth. So steady growth indicates that we have constant growth here. But there's more than one place where it indicates that we need to use the constant growth equation. Here, it says dividends of 5.1% per year. That's the growth rate. So when you see words per year, it indicates something is constant. What is constant? That 5.1% constant growth rate. Okay, so G, constant growth rate of 5.1%. The current price is $25, so that is our P0. Okay, so now we know that we need to apply constant growth equation to solve for the R. So the equation is here. Our D1 is 1.5, P0, 25, G is 0.051. Okay, so we should have cost of equity that is 11.1%. So assuming that this is the same company that we used, that we also use CAPM to solve for the cost of equity last time. So if your dividend model says that the cost of equity is 11.1%, while the CAPM equation tells us that the cost of equity is 13.5%, that's from slide number 6, they're pretty similar, okay? You should be pretty comfortable with your estimates. So you can probably just use the simple average of these two costs of equity as the cost of equity for your firm. Okay, but if these two are very different, one is 11.5%, the other one is 23%, then something is wrong, okay? Something is wrong, and potentially it's not your calculation. So we need to use additional models in order to estimate your cost of equity. And chances are the market model will be required, okay? Okay, so where are we? Okay, there we go. That's slide number 12. So let's continue. What if we don't have constant growth scenario? What if we have zero growth scenario? Then that's actually easier, okay? So when you have a common stock that pays fixed dividends, or if your company has preferred stock outstanding, then the zero growth model will be appropriate. Just so we're clear, the preferred stocks always pay fixed dividend, okay? So in that case, if you're trying to solve for the cost of preferred stock, then automatically you should know that you should use the zero growth model. So the zero growth model says that P0, well, P0 equals to the annual dividend divided by your required rate of return. So we are going to, again, by using the assumptions that we used earlier on just one slide earlier was the constant growth scenario. We'll have to assume that whatever the stock price is right now, we'll have to assume that it is traded at its equilibrium. Then assume that if those investors are willing to hold on to the stock, they are implicitly agreeing that whatever the required rate of return is, it is acceptable. So we rearrange this equation to solve for the implied required rate of return. So all we need to do mathematically is to swap again your denominator with your P0 on the left. So we now have R equals to the annual dividend divided by P0. Okay, so it's a very simple mathematical transformation. So let's look at the numerical example. If your company has preferred stock that has an annual dividend, okay, so this is annual rate, that's our D. And the current stock price is $25. That is our P0. Okay, what is the cost of preferred stock? And here's the equation on the left. Okay, so required rate, implied required rate of return is D, annual dividend of $3 divided by P0 of $25. And it is 12%. Okay, 12%. That's very simple. But the next one may be a little tricky. Okay, but I think some of you can answer it quickly. So we know that the current price is P0 based on the information here. Okay, we know that the P0 is $25, annual dividend is $3, the required return is 12%. Okay. Now, what if I don't want you to find P0 because P0 is already given? What if I'm trying to figure out what will be P1, stock price a year from now, or P10, stock price 10 years from now? What should they be if the dividend and required return stay the same? Anybody? Anybody? Okay, so remember that stocks don't have maturity date. So the time to maturity is equal to infinity, right? So, and since preferred stock dividends are always the same, and that's why we use perpetuity equation. This is basically the perpetuity equation. Right? It's not just any simple annuity cash flow, but it is annuity cash flows that last forever. So in this case, N equals to perpetuity or infinity. Okay, so if I buy the stock right now, I will receive infinite number of payments. But what if I buy the stock a year from now? How many dividend payments would I get? A year from now, I will receive infinite number of payments minus 1. So what is infinity minus 1, mathematically speaking? It's still infinity, exactly. What if 10 years from now? What if 10 years from now? If you buy the stock 10 years from now, how many dividend payments would you get? It will be infinity minus 10 payments. What would that be? It is still infinity. So whether you buy the stock right now, a year from now, 10 years from now, or even 100 years from now, infinity minus any finite number, by definition, it will still give us infinity, which means even if we buy the stock 100 years from now, I will still receive infinite number of payments. So 100 years from now, I will still have perpetuity cash flows, which means that I will still use the exact same equation here to find the P0. So for as long as my numerator and denominator stay the same, my price of the preferred stock will remain the same. How much is it? $25. Okay. So for as long as the dividend and required return stay the same, right? If the numerator and denominator stay the same, your price of the stock will remain the same as well, whether it is 1 year from now or 100 years from now. Okay, so we're done reviewing for the cost of equity and cost of preferred stock. Let's talk about cost of debt. Okay, cost of debt is the required rate of return that your bondholders demand. Okay, it's the rate of return that they want to earn per year in order to keep them happy. If they're unhappy, they will dump your bond and invest the money elsewhere, right? So the required rate of return mathematically is the yield to maturity. Okay, the yield to maturity. And if you're using the financial calculator function keys, it is the IY that is located on the third row of the financial calculator. Okay, oops. It is those 5 function keys that are located on the third row of a financial calculator, right? You can solve for any one of the 5 unknowns for as long as you have the input information for the other 4 variables. And to solve for cost of debt, we're computing for the IY, okay? And conceptually, that is the yield to maturity or the current required rate of return. Okay, so we need to know that your cost of debt is not your coupon rate, okay? Remember that we reviewed in chapter 8, okay, that the coupon rate is typically fixed for the life of the bond. Okay, and typically when the bonds are issued, we will first of all figure out what is the yield of maturity, what is the required rate of return that our bondholders demand right now. And typically we'll set a coupon rate equal to that yield to maturity at the time of issuance. However, after the bonds have been issued, coupon rate will remain fixed for the life of the bond. Okay, while on the other hand, yield to maturity is variable. So every time when the investors believe that the risk level of the bond has gone up, then they will naturally increase their required rate of return or yield to maturity. Right. On the other hand, if the perceived level of risk on the bond goes down, then the yield to maturity will go down. Okay, the required return, the R, okay, risk and return have positive relationship. Okay, so what we want is we need to figure out what is the current required rate of return, not the required rate of return that took place when the bond was issued. Okay, so the required rate of return is yield to maturity rather than the coupon rate. So let's solve for the yield to maturity or cost of debt. So suppose we have a bond issue currently outstanding that has 25 years left to maturity. So that's our N, okay, equals to 25. Payments if we have annual coupons, but that's not what we have. Okay, the coupon rate is 9%. So 9%, we'll use that to calculate our coupon payment or annuity cash flow. It is 9% of the $1,000 par value that you, the bondholder, lent to the corporation, the issuer. So 9% of the $1,000, you'll be $90 per year, but it says the coupon payments are paid semi-annually. So rather than receiving $90 once a year, you get only half as much, but every 6 months. So you'll be $45 every 6 months. Then N is 25 years times, you get 2 coupon payments per year. So you will get $45 coupon payments 50 times. Okay, so 50 coupon payments at $45 each until the bond matures 25 years from now. And after receiving all the coupon payments, right, 50 coupon payments at $45 each, that $1,000 par value that you lent to the issuer will be returned back to you. So the coupon payments and par value are both stated as cash inflows. okay? Because we typically look at it from the bondholder's perspective. So if I were to buy the bond right now, okay, the present value is if I were to buy the bond right now at this price. If you were to buy, it is a cash outflow. So negative 908.72 as your present value. Right, so we'll have entered input for the other 4 variables. Now we can simply compute for our IY. Now, if I plug in those numbers, I need to make one final modification. Okay, so N is 50, payment is 45, par value is 1,000 or future value, present value 908.72 is the cash outflow. Okay, so when I press compute IY, I am not quite done. There's one last step that I need to take. What is it? Exactly, multiply by 2, because I have entered all of the inputs here based on semi-annual cash flows or semi-annual compounds. So with semi-annual inputs, I will be given a semi-annual output. That tells me that the IY is actually a semi-annual rate or a 6-month rate. So once I find out, my calculator tells me IY equals to 5%, that's 6-month rate. I need to multiply by 2 in order to find my annual rate. So the correct answer is actually 10%, okay, not the 5%. Next, oops, why did it disappear? There we go. Okay, next, well, in chapter 6, we mentioned that when we're talking about which cash flow should be relevant, which one should not be relevant, we mentioned 2 things that we're going to need. Okay, one is that taxes are always relevant. Okay, at least in the United States, we cannot avoid paying taxes. So what we need to figure out is after taking taxes into consideration, what will be our cash inflow, what will be the cash outflow, etc. So since when the corporation pays interest on anything borrowed, that interest expense is tax deductible. Therefore, we need to figure out after solving for the cost of debt, we need to convert that into after-tax cost of debt. And how do we adjust for that tax impact? To illustrate that tax impact, I'm going to use this demonstration. Okay. So you can take a few seconds to copy this down. Okay. I inserted this just a couple of minutes before the class, just to save time. Okay, so we'll have our pro forma income statement here again. And this is the same firm, okay, same company, same corporation, but we'll have 2 different scenarios. The one in the middle column is the scenario where we have debt. Okay, we're going to keep the numbers really small. So assuming that you only owe $1,500 of debt. And for the amount that you borrow, you have agreed to pay 10% interest. Well, the scenario here on the right-hand column, it has no debt. So the market value of debt is $0. If you don't owe anything, you don't have to pay any interest. Okay, so start with the first item on your income statement. It is sales or revenues, okay, whichever term that you prefer to use. We're going to, again, keep the numbers really small. So assuming sales of $1,000, costs or cost of goods sold, $300, depreciation, $200. Okay, so again, this is the same firm. Well, the only difference is that one has debt and one has no debt. So we're going to look at the tax impact on your debt. So for the middle column, $1,000 of sales minus $300 of costs minus depreciation, $200. That will give us EBIT of $500. And for the right-hand side, it is exactly the same. EBIT is $500. So for the scenario here in the middle column, you borrowed $1,500 and you agreed to pay 10% interest on that $1,500 that you owe. So 10% of $1,500, it is $150 per year as interest expense. So moving that information here, It tells me my interest expense is 1500 times 0.1, which is $150 per year. And for the scenario here on the right-hand side, when you have no debt, you don't owe any money, you don't have to pay any interest. So your interest expense is $0. Okay, we can calculate taxable, taxable income here. Okay, 500 minus 150 will give us taxable income of 350. Multiplying that by the 37% tax rate, it will give us $129.50 of taxes. For the right-hand side, 500 EBIT minus 0 interest will give us taxable income of 500, and that 500 multiplied by the same 30% marginal tax rate, it will give us $185 of taxes. So the truth is that you don't have to continue with the calculation from here to find the operating cash flow, but if you really want to do it, you can still do it. Okay, 570.50 for the middle column versus the $515 in the right-hand column. That's the operating cash flow. So let's look at those numbers closely. Okay, let's compare the two taxes, the one from the middle column versus the one on the right-hand column. So what do we see when we compare these two taxes? We see that when the company has interest expense, okay, it reduces our taxable income, right? It reduces the taxable income from $500 to $350. So while tax rate remains the same, it reduces our taxes. So it is how much reduction in taxes? It is $55.50 of tax savings. Tax savings that is called interest tax shield. Interest dash tax shield, S-H-I-E-L-D. Oops, I'm in that area on the screen that the sensor doesn't work. Let me try here. Interest tax shield. Okay, so at the surface, it may seem like we paid $150 of interest expense, but we actually end up saving $55.50 of taxes. And we see that the taxes are lower here. So what is the after-tax interest expense? Before tax interest expense is $150, okay? So after tax interest is the $150 of interest expense, right, minus the interest tax shield, well, minus the, interest tax shield. Okay, so at the beginning, it may seem like we paid $150 of interest, but we saved $55.50 in taxes. Oops. So after tax interest expense is actually only $94.50. Okay, so at the surface, it may seem like you paid $150 of interest expense, but because you have tax savings, the after-tax cost is actually only $94.50. So the easiest way to solve for after tax, to convert before tax interest expense into after tax interest expense, the easiest way is to use this equation. We simply start with the before tax cost, then we multiply it by 1 minus T, 1 minus the marginal tax rate. So for example, before tax, it costs us $150. If we multiply by 1 minus T, 1 minus the 37%, okay, 0.37, it will give us the $94.50 directly without having to construct a whole income statement or two pro forma income statement and find the interest tax shield and figure it out. Okay, that's a very long way. So this is the quicker way. So you simply multiply the before tax cost by 1 minus t, and that will allow us to convert before tax cost into after tax cost, right? This number and this number are exactly the same. So we're going to use this shortcut to convert the yield to maturity into after tax cost of debt. So I'm going to delete this. So earlier on slide number, I think in your case, you should be slide number 15. Okay, we know that the cost of debt is 10% or the IY, right? Also known as yield to maturity. But if we know that the marginal tax rate is 37%, or actually in this case, let's go ahead, find the after-tax cost of debt. So you will be the yield to maturity or cost of debt multiplied by 1 minus t. Very simple. So it's 10% as cost of debt or yield to maturity multiplied by 1 minus the 37%, that's 0.63. Okay, so you'll be 6.3% as the after-tax cost of debt. Okay, 6.3%. Well, the cost of debt is just the yield to maturity of 10% that we solved earlier. Okay. So let's put everything together. Okay. So what have we figured out so far? We have figured out that our after-tax cost of debt, well, there we go. Cost of debt is notated by RD, okay? So that's equal to 6.3%. And we also have cost of equity that was calculated to be 11.1%. Well, are we using the same numbers? So let's see. Maybe not. Okay, no, we're not using the same numbers, so never mind. Okay, let's just forget about this. We're gonna start from scratch, okay? So once we know the cost of equity, cost of debt, then what do? So let's start with the easiest scenario, okay? In one extreme, if we have a company that is 100% financed by only common stock, then in that case, once you find the cost of equity, you are done. That cost of equity is your company's weighted average cost of capital. Okay, because if it is 100% equity finance company, it means that it only has common stock outstanding. There's no preferred stock, there's no debt outstanding. Okay, so your cost of equity is simply your weighted average cost of capital. Now, on the other extreme, what if you have a corporation that is 100% financed through debt, but it has no common stock outstanding, it has no preferred stock outstanding? In that case, once you find the after-tax cost of debt, that after-tax cost of debt is your weighted average cost of capital for your corporation. Okay. However, 99.99% of the time, you're not going to find a corporation that is in either one of these two extremes. Okay. In most cases, corporations, if you learned M&M propositions before, you know that the optimal capital structure way is a combination of different things. Okay. Some through equity, some through debt. Okay. So 99.999% of the time, corporations will have mixture of equity and debt. Okay, so in that case, we have to solve for the weighted average of those required return demanded by the different types of investors, okay, including common stockholders, preferred stockholders, and bondholders. Even though in the real world, at least in America, roughly only 10% of the corporations do have preferred stock outstanding. But even in that case, you still have to take consideration of cost of equity and cost of debt, okay, when you calculate the weighted average cost of capital for your corporation. So this is the equation. So we know RS is cost of equity, RP is cost of preferred stock, while RD times 1 minus the tax rate is our after-tax cost of capital. So we know that already. But what are the W's? The W's are capital structure weights. in order to calculate your capital structure weight, we need to talk about a few more notations. Okay, so we're going to let S equals to market value of equity. P, this is not sub P, okay, but capitalized P. P equals to the market value of preferred stock. Okay, capitalized D equals to market value of debt. While A, capitalized A, equals to market value of assets. And mathematically, it is equal to market value of equity plus market value of preferred stock plus market value of debt. Okay, you add those components. You add the three market values together to get market value of assets. And in the first numerical example, those market values are given to us. But what if they are not given to us directly, which means we'll have to calculate? Then let's talk about how do we calculate them. Okay. Okay, so here, S market value of equity, if it's not given to us directly, we can calculate it by using price of common stock per share, price, multiplied by the number of outstanding shares of common stock. Some space, I'm going to shrink the fonts a little bit. Price of common stock, that's price per share of common stock multiplied by the number of outstanding shares of common stock. And using the same line of logic, okay, P, the market value of preferred stock, you will be the price of preferred stock. That's per share, then multiplied by the number of outstanding shares of preferred stock. D, market value of debt, you will be price of bond multiplied by the number of bonds outstanding. Okay. Basically, it's always price per unit times the number of outstanding, whatever that is. Okay, shares of stock or number of bonds outstanding. And now let's go back to, let's solve for the capital structure weights, which tell us the proportion of the money, okay, of the company that's actually financed through that type of asset. So to solve for capital structure weight for common stock, you will be market value of common stock, notated by S, divided by market value of assets. Okay, very simple calculation. The capital structure weight of preferred stock, you will be market value of preferred stock, notated by P, divided by the same denominator, market value of assets. Okay, WD, capital structure weight of debt, you will be market value of debt divided by market value of assets. Okay, it tells us the proportion of the company that is actually financed through either common stock, preferred stock, or debt. So moving on, so let's start the whole calculation from scratch. Okay, so this is a brand new numerical example. So we're going to calculate every input, then merge them together to calculate the weighted average cost of capital. Okay, well, this is the equation here. Okay, so the company's average beta is 0.82. This is our beta. Now, when the beta is given to us, it should be a good indication that we need to use CAPM equation here, especially while risk-free rate. That's one other major components of the CAPM equation, right? That's the RF. Market risk premium, 8.4%. I'm going to use the initials, market risk premium. And equation-wise, it is this term in the parentheses. So the cost of equity is, okay, plugging in the numbers, 0.03 as risk-free rate, beta of 0.82 multiplied by market risk premium, 0.084. Then we have 9.89% as our cost of equity. That's the rate of return that our common stockholders demand. And by the way, we should be able to interpret this cap and beta here easily, right? Because we know conceptually that the market portfolio or that market average has a beta of 1, while higher beta means higher systematic risk. So since this 0.82 is lower than 1, we can conclude that this company has lower systematic risk than market average. Okay, it has lower systematic risk than the market average, because the market average has a beta of 1. Okay, so I'm going to copy this number here. RS, cost of equity, is 9.89%. We will use that number again when we have to merge all the numbers together to solve for the WACC. So next, the company has outstanding bonds with $1,000 par value, which is the standard. Okay, it has 15 years to maturity. So N equals to 15 if we have annual coupon. No, we don't. We have semi-annual coupons. So 15 years times 2 coupon payments per year. So that means if someone were to buy this bond right now, he or she will receive a total of 30 coupon payments, right? 6 months each time. The 9% coupon, so that means payment is going to be 9% times 1,000. That's $90 per year. But if it is paid semi-annually, each time you only get half as much. So it's $45 every 6 months. Okay, and after receiving all those coupon payments, you as the bondholder will receive the $1,000, which is the amount that you lent to the issuer. And therefore, it is the amount that will be returned back to you at maturity. And this current price, that's our P0 or present value, right? If you look at it from the bondholder's perspective, this is the price you have to pay now in order to receive those future cash inflows, such as coupon payments and par value. Okay, so 1086.46 is the cash outflow. So once you enter all those 4 inputs, you can compute for IY, CPT, IY. And remember that we have entered all the inputs based on semi-annual rate, which means that this output is also going to be a semi-annual rate. To convert the IY into annual rate, you have to, in this case, multiply by 2. Okay, just a little delay there. So your IY or cost of debt should actually be 8%, okay, not 4%, 8%. So I will copy that number here, RD equals to 8%. But we actually need to convert the cost of debt into after-tax cost of debt, because interest expense is tax deductible, okay? So at the surface, it may look like we pay 8%, but actually we pay lower than that because we get to save a little money on taxes. So after-tax cost of debt is our RD multiplied by 1 minus the tax rate. So 8% times 1 minus 37%, that's the same as 0.63. And you will give us 5.04%. 5.04% as the after-tax cost of debt. So let me use that here instead. Oops. Okay, let's continue. So if the market value of equity is $136 million, so this is our S, market value of equity, or market value of debt is $64 million. So this is capitalized D, okay? So that tells us what? That tells us that A, market value of assets is the sum of market value of equity and market value of debt. So when you add these two numbers together, Market value of assets in this case is $200 million. Okay. So we need those numbers in order to calculate for the capital structure weights, the W's. Okay. There we go. So let's plug in the numbers. Capital structure weight for common stock or capital structure weight for equity, market value of equity, 136, divided by market value of assets, 200. Okay. Then capital structure weight for debt, you'll be market value of debt, which is 64, divided by market value of asset, 200. Okay, so this capital structure weight for debt is 32%. That means the capital structure weight for the common stock is going to be 64%. That's because when you add those capital structure weights together, you should end up with, 68%. You should end up with 100% as the sum, okay? So this should be 64 here. Okay, so now we have all the inputs. Let's calculate for the WACC, which is capital structure weight for common stock multiplied by the cost of common stock plus capital structure weight of debt multiplied by the after-tax cost of debt. So that's RD times 1 minus T. Okay, so let's plug in the numbers. WS, 68%, so 0.68, multiplied by the cost of equity. And we calculated that earlier, that was 9.89%, so 0.0989 plus WD, it is 0.32, right? We calculated that here, multiplied by the after-tax cost of debt, and that is 5.04%. So times 0.0504, and that will give us 0.0834, or you can say that is 8.34% as the weighted average cost of capital. Okay. So this is a simplified numerical example. We're going to continue. And we are going to add preferred stock. In this case, the market value of preferred stock is not given to us, so we have to calculate for it. Okay. There we go. So moving on. So continued from the previous example. What if the company also has 1 million shares of preferred stock outstanding with current price of $20 per share? So rather than being given the market value of preferred stock, we don't know what it is. So that means we have to calculate for it. Okay, P is the market value of preferred stock, and we know that's price per share. How much is the price per share? $20 per share times the number of outstanding shares. You will have 1 million shares outstanding. So that means market value of preferred stock is $20 million. Okay. So with that, we can calculate for the market value of assets, which will be the sum of market value of equity plus market value of debt plus market value of preferred stock. So this is 134 or 136? 136 million plus 64 million plus 20 million. So we'll have a total of $220 million. Okay, as market value of assets. Okay. So we have to recalculate for all the capital structure weights. Okay, because the denominator is no longer $200 million, but it's $220 million. So WS, it will be 136 divided by 220. Okay, WP will be market value of preferred stock divided by market value of assets. So mathematically, it is 20 divided by 220. Capital structure weight of debt, you'll be market value of debt divided by market value of assets. And the numbers are 64 divided by 220. So after plugging in the numbers to our calculator, we should end up with, let me erase this so I can have space. Okay, we should end up with capital structure weight of equity that is equal to 61.82%. Capital structure weight for preferred stock should be here 9.09%. Capital structure weight of debt, 64 divided by 220, it should give us the 29.09%. Okay, 29.09%. Okay, so those are the capital structure weights. But we have not solved for the cost of preferred stock. Let's find the cost of preferred stock. Okay, so we know that preferred stocks almost always pay fixed dividends. So that means if we were to solve for P0, it would be D divided by R. But we're solving for the R instead. Okay, so rearranging the equation, R equals to D divided by P0. So what is the dividend? So read the question carefully. And here I underlined the keywords for you. Okay, we have the 80 cents is not annual dividend, but it is quarterly dividend. Okay, assuming that it's paid quarterly every quarter, so we have to multiply this 80 cents by 4 to convert the quarterly dividend into annual dividend. So 0.8 times 4 divided by P0. P0 is $20. So it will give us required return by the preferred stockholders. It is 16%. Okay, cost of preferred stock is 16%. And now we literally have all the inputs that we need to find the WACC for the corporation. Okay, so we simply add another component. Now with the preferred stock, we'll add WP multiplied by RP. Okay, so this is the WACC now. So capital structure weight for common stock is 61.82%. So 0.6182 multiplied by the cost of equity. Cost of equity, we calculated that earlier, and it's the same 9.89%. So 0.0989. Okay, plus capital structure weight for debt. WD, it is 29.09%. So 0.2909 multiplied by, this is after tax cost of debt, and that is here, 5.04%. So 0.0504. Plus capital structure weight of preferred stock, 9.09%, so 0.0909 times cost of preferred stock, 16%. Then we're done. Okay, so the final answer should be 9.03%. Okay, so the calculation should be mostly reviewed, but let's add to it so that we can complete our case analysis. So we also need to know this. Okay. So in real world practice, any project's cost of capital, it has to be dependent on the risk of the project rather than the risk of the corporation. Therefore, therefore, the firm's beta and the weighted average cost of capital may not always be appropriate for the new project. Okay, because if the new project turns out to be riskier than the company's existing operation, then we need to make adjustment according to that risk. Higher risk should require a higher required return or higher R. So if the project has a different risk from the existing operation of the corporation, or if you simply do not find the firm's beta to be reliable, then what do you need to do? If your company's beta is not reliable, you can use industry beta. Okay, since many studies have found that industry betas tend to be much more stable and therefore reliable through time. Okay, and in a team project, we're going to use this pure play approach. So what is pure play approach? Okay, so we can use either pure play approach if it's doable, but if it's not obtainable, we can use subjective approach to determine the accurate or the appropriate discount rate for the new project. And what is the pure play approach? So the pure play approach says that we need to find at least one, okay, preferably more than one comparable firms that operate in that same industry, okay, that operate in that particular industry that we are trying to evaluate. Then for each comparable firm, we will find the beta. Okay, so one beta for each comparable firm. Then from the various betas, we will find the simple average from that. Then use that average beta to plug into the CAPM equation in order to find your cost of equity by using CAPM. But that's just, again, one of the multiple cost of equity estimates that we have to calculate, okay, because none of the models is that reliable. But we're going to find that in the real world practice, it is becoming more and more difficult to find pure play companies. Okay, so basically as investors, we know that we need to diversify, right? You should never invest only in one asset, never in only one company. We want to diversify or put our eggs in separate assets and different companies so that when one investment goes under, we don't lose our life savings, right? So corporate managers are doing the same thing as well. They have learned that they should diversify. So you will find that there are fewer and fewer companies that will operate in only one industry. And many of them, they are conglomerates, they operate in multiple industries. So it's becoming more and more difficult to find companies that only operate in one industry or one product line. And that's why it is becoming more and more difficult to find pure play companies that only sell, one product or one service. So if the pure play approach does not work, okay, it's not obtainable, then you are left with the subjective approach. Okay, so trust your instinct and your common sense. So you will simply consider the project risk level that's relative to the company's existing operation. Okay, so if the project is riskier than the company's current operation, and once you find the WACC of a company, you're going to add some percentage, a couple of percentage to that, depending on how much riskier it is, right? So we know that risk and return have positive relationship. So when risk goes up, the required return should also go up. So if the project is riskier than the company's existing operation, you need to find the WACC, then increase from there. But if the opposite is true, if the project that you are evaluating is less risky than the company's current operation, then once you find the WACC, you're going to reduce from that WACC. Okay. So even though this subjective approach is not perfect, but an imperfect adjustment is better than no adjustment at all. Okay. So that's the conclusion. Now for the team project, I have posted the instruction